Hi, Matt McAleer, President, Director of Private Wealth, April 4th, with the Moose, John Mousseau, our Chief Investment Officer. We're going to start off with the good news this week. Moose, bond land had a good week.
Had a good week, and all because of the tariffs, right? You stock a Treasury bond, which dropped 25 basis points, 425. We're closing at a 4. It was actually down even 10 basis points lower midday. All of this, we've talked about it before. When there's trouble out there, what do people do? They run to the safety of Treasury bonds.
Right.
This time, no different. We were talking about it last week, how things had started to move down because of concerns, but not so much tariffs, which overwhelmed everything in the middle of this week, but because the economy is slowing down. By the way, municipal bond yields, after being very sticky high, they moved down this week about 30 basis points across the curve. And it's not like a lot of economic news. The jobs number today was better than expected, but the revision took away jobs from last month, so the net is a little higher. Nobody cared. What they cared about was the fact that the tug of war on tariffs between whether they raise inflation or slow growth, well, in bond land, the slower growth is winning out. And that's why munis caught a bid too, because they're not even going to be talking about taxing munis while all of this is going on. So all bonds did well, unfortunately, at the expense of equities.
Yeah, and we spoke last week about how diversification, which had become a four-letter word, I've said that before, has finally started to be helpful to clients. Bonds were strong. Up until today, international equity had held in and is still positive, up about 4% in the broad international indices year to date. So some of that diversification has helped well-rounded portfolios. But equities, I'll tell you what, midday Wednesday, up on the week.
Right.
Things traded well. It's the headlines you've read for days now. Just a confusing, almost shocking type of interview on the tariffs in the Rose Garden there. Really took the wind out of the sails, and supply is just hammering demand right now.
That's right.
It started initially where some of the defensive names in defensive areas hung in there pretty well. As a matter of fact, near the end of Thursday, Berkshire Hathaway was down a quarter of a point. Since then, it's started to, you can't stand as an island in the equity market when you're getting that kind of selling. What do we do here? Well, in terms of what we did this week, we got a little bit lucky. In US ETF, we were a seller of aerospace and defense on Wednesday afternoon just because it had hit a target.
Right.
Not the complete position, but we took it down. That brought cash up in US ETF between 7, 8, 9%, depending on
a little bit of a buffer.
Yeah. Over in tactical trend between the treasuries and the cash, 20%, 22%. We've got some dry powder there. International got a little lucky again. As some of the countries rallied in March, we took them off the table.
Right.
South Korea being one. And that's left us with about 13% cash in international. We didn't do much buying this week. We did add in tactical to KCE today. That's the brokers and banks. You can even throw some insurance companies in there.
Also beat up.
Also beat up. You're talking about a collection of financials that in January was trading at 140 that we bought today at 111.
Right.
Just to give you...
It's unbelievable.
Think about the kind of price action you're seeing and fear you're seeing. So that also brings up a gauge. In terms of some of the analytics, the fear numbers are starting to register extremes. I'll look at the CBOE put-call ratio, equity only, over the weekend. But it did crack one yesterday. Thursday, it was a 102.
Wow.
Very
rare.
Rare. Remember, that 102 represents more puts being bought than calls, which is against the norm when we're tracking that put-call ratio. When we get through 1, so 1 put being bought for every 1 call, we start to look to pick. If we get a second number through 1, get a little bit more aggressive.
Right.
Now, what would I like to see to get to really start buying aggressively? We follow a couple momentum indicators. I've mentioned them on here before. The weekly momentum indicator is one that's been fairly successful for us. It's gotten down into the single digits. So in other words, only 5, 6, 7% of some sectors, the companies in that sector are trading with positive momentum. As you approach 2 and 0,
Right.
there does become an opportunity, but you want to see that turn up first. If we're just buying as it keeps descending, you can run into this scenario where the market burns through your cash.
Right.
So you want to protect your cash, number one, what cash you may have allocated. Number two, you want to always protect your mentality from a trading standpoint. If you're constantly trying to catch bottoms, to call bottoms, to say, oh, it can't go lower, you're burning up a lot of mental capital.
You're just throwing rocks.
Trading often is thought of as a mathematical exercise or an exercise that is based on statistics and based on fundamentals and macro. One thing that's rarely discussed is the emotional behavior of the investor or the trader. So protecting that outlook can be very beneficial. The other thing we're looking at is in a scenario where markets get hit because of interest rates or credit,
Right.
or slowing economy or a bad jobs number or unemployment.
This is a different fish.
Yeah. You can factor that in to kind of worst case scenarios, best case scenarios. Right now, you have a scenario where you're throwing darts valuation wise.
Right.
So that's going to keep volatility on, at a decent level. We hit 45 on the VIX today.
Wow.
Keep in mind, we spent most of January and February in the low teens. So you've seen an awful lot of volatility. That portends the next 30 days, probably a good dose of volatility. It will create opportunities, but I don't think you have to be too fast on the trigger.
No, because you're reacting to circumstances that we haven't had for a long time. Because most of the time, last few years, you get a decent downdraft. What do people do? They come in and buy it.
Yeah.
If you did it this time, you got your hands burned.
It reminds me a little bit about COVID.
Right.
Remember, John?
Sure.
We're looking at markets during COVID where you had a difficult time structuring some statistical models, right? Because it was something out of left field. Now, Trump and DC had talked about tariffs ad infinitum. The data that came out wasn't purely tariffs.
No, not at all.
There was an import-export ratio levered in here that,
with formulas that people didn't understand. You went from people thinking you'd have reciprocity on tariffs to suddenly, we're just going to base it on what their trade surplus is of the U.S. Boom.
Right. Odd. Very odd. So we'll see what happens. Keep in mind, John and I think we agree on this because we chat about it in the past. In the short term, politics in Washington can dictate things to the market. In other words, the market reacts to Washington. In the intermediate and long term, the markets dictate to Washington.
That's right.
So we'll see how long that rope's going to be, but that isn't a rope that extends very long. Not with midterms next year. Once politicians start seeing their job, the ability to get reelected, slipping away, some things will change.
And remember, people are going to start campaigning for midterm elections less than a year from now.
Oh, yeah, probably 6 months.
Right.
All right, we'll see what next week brings. Get a good weekend's worth of sleep. Stay calm, enjoy yourselves, and we'll be back at it.